On behalf of our team at HBKS Wealth Advisors, I would like to welcome you to a conversation on the economy with HBKS Chief Investment Officer Brian Sommers and First Trust Chief Economist Brian Wesbury. Our session is scheduled for 60 minutes and is being recorded. Please note that all attendees are set up in listen-only mode. A copy of the recording will be emailed to you tomorrow and be available on the HBKS Wealth website. At this time, I would like to turn it over to Brian Sommers from HBKS.
Thank you, Lori, and good afternoon, everyone. And thank you for joining us. As we formulate our market and economic outlook at HBKS, we get input from multiple thought leaders in the investment industry. In early April, we held a webinar where I provided our views on the economy and how stock markets may react going forward. At that time, there was so much uncertainty surrounding COVID-19, it was very difficult to make any definitive projections. Still, we were cautiously optimistic that while a recession caused by the global lockdown could be severe, it would only last for a short time and the stock market would end the year higher than it was at the end of 2019. So far, the economy and stock markets appear to be following this path. More than 2 months later, we have a little more certainty, but there's still a lot that is unknown. So we thought at this time that it would be helpful to bring the perspective of one of the top economic thought leaders to our clients. We have with us today Brian Wesbury. Brian is the Chief Economist at First Trust Advisors. In his long and distinguished career, Brian has served as the Chief Economist for the Joint Economic Committee of the U.S. Congress and as a member of the Academic Advisory Council of the Federal Reserve Bank of Chicago. Brian also has been a regular attendee of the Economist Roundtable Luncheon at the Chicago office of the Federal Reserve. His writings appear in various magazines, newspapers, and blogs, and he regularly appears on Bloomberg, CNBC, and Fox Business. And if that's not enough, the Wall Street Journal ranked Brian the nation's #1 U.S. economic forecaster in 2001, and USA Today ranked him as one of the top 10 forecasters in 2004. So, Brian, thank you for being with us today.
Brian, it is great to be with you, and thanks for that introduction. I do want to remind everyone that back in 2001, it is a long time ago now, but the Wall Street Journal gave me that award for predicting a recession. So, it's kind of funny when you're bullish, sometimes people call you a perma bull. But back in 2001, I actually did predict that recession, and I will hold on to that as one of my badges of honor. But it's also proof that I'm not always a perma bull on the economy.
Well, you should definitely hold on to that honor. That's a big honor. But so to begin with, let's talk about where we are in the economic recovery. During the lockdown, as everyone is aware, business activity slowed dramatically. In particular, spending at restaurants, hotels, and on transportation practically grinded to a halt. And as most states begin to come out of the lockdown, economic activity has been recovering. Manufacturing activity has been slow to recover, but recently the manufacturing data that was released showed solid improvement. Other data has been better than expected. New home sales have rebounded strongly. The unemployment situation is improving every week. The food and travel industries are slowly getting back to business, and retail sales have bounced back much stronger than expected. And so it appears that economists were underestimating how quickly economic activity would rebound. And so, Brian, you were saying economic activity would rebound quickly, while other economists were predicting a slower recovery. So how fast do you think the economy can get back to pre-COVID-19 growth levels, especially while the fears of a second wave of infections have risen the past few days?
Yeah, Brian, that's a big question. We always felt that this would be one of the shortest recessions on record, but also one of the deepest recessions on record. And it's all about the shutdown. That's really what it's about. And so I just want to stop for a second and kind of, most recessions are caused by some major policy mistake. And I'm talking about economic policy. So the Federal Reserve raises interest rates too much. They take too much money out of the economy, causing deflation like they did in the Great Depression. In Japan, there have been recessions associated with tax hikes. And so when you look over time, it's usually the Fed or taxes which cause recessions. This time, we went into this with extremely low interest rates. We didn't change tax rates, and yet we had a recession. And so the reason I'm going here is that it's a different kind of beast than economists or investors normally deal with. And so it's all about, and I think everyone on the call understands this, it's all about how long we stay shut down, how severe the shutdowns were, or whether we shut down again, as you alluded to, Brian. And so those are the things that we are dealing with. Now, before I go on, I just want to quickly kind of touch base and say that, unemployment rates and housing starts and all these numbers that you and I follow so closely, Brian, we know they're lagged. We will not get second quarter GDP numbers, and remember that's April, May, and June. They won't come out until the end of July. So if you were, decided to wait until the end of July before you made a decision about the economy, you would be dealing with extremely old, lagged data. So that's why what we at First Trust, and I know you, Brian, have followed this as well, but are looking at what we call high-frequency economic data. There are many pieces of economic information that come out on a weekly basis, others that come out even on a daily basis. So initial jobless claims come out every week, and they have now improved. They're still high. When 1.5 million people file for unemployment benefits, that's a huge number, but it is way below where it was 11 weeks ago, and every single week for 11 weeks we've seen improvement. If you look at weekly retail sales, they have begun to improve. We get box office receipts, so that would be movie theater tickets. A year ago, they were running 200. If you had a blockbuster out, you might get 500 million a week. But we bottomed because every theater basically in the country was closed. We bottomed at $5,000 of ticket sales in a week, and that was all for outdoor drive-in movie theaters. We're now back up to 750,000, so the improvement there is huge, but we are still way below where we were last year. Rail car traffic, steel production, we get weekly data on that. Both of them are up in the past week and the past month and significantly up from the bottom. Hotel occupancy at its worst was down 80% from a year ago. It's now down 40%. So you can clearly see that more people are traveling. And on top of that, we can watch airplane traffic, and we measure that using number of people going through the TSA, the body cavity search when you try to fly an airplane. And that bottomed at about 80,000 people a day. It is now up over 500,000 people a day, but that's still significantly below 2.5 million from a year ago. So while we clearly see a sharp bounce off the bottom, 80,000 people going through TSA, now up to over 500,000, and that's kind of a V-shaped bounce. The question is, how long will it take us to get back where we were? That's what you asked. That's what we constantly are thinking about, Brian. And I'm going to tell you, I think it's going to take time. Not only do we have the fears of a second wave out there and the potential for politicians to shut the economy down again, the governors and the mayors of different cities. I'm sure we can talk about this. I'll just allude to it. I personally do not think we will have the kind of shutdown that we have already seen again, because now people realize how damaging it was, and we can talk about that in a minute. But in order to get back to normal, it means people have to get back to normal. And we have to see the opening of the businesses that have closed. And so I know I'm giving a long answer here, but the bottom line is that there are millions of small businesses that, because of the shutdown, will never reopen. And those are jobs that will take a long, long time to come back. Let's say you owned a restaurant for 35 years. You were already looking for a way out. You've been working 13 hours a day, 7 days a week for a long, long time. You've made a success of it, and then the shutdown comes, and there are numbers and hundreds of thousands of businesses that said, "All right, that's it." That was the sign that they were going to throw in the towel. Others just couldn't last. Even with government money, if you can only open your restaurant with 50% of the seats or 25% of the seats, you might not be able to pay your rent. You might not be able. You certainly can't call all your employees back. So what I will tell you, Brian, is that I think it's going to take a number of years before we get back to where we were. And then the final piece of this is, when will people feel normal again? And I know we might talk about this more, but I use 9/11 as my example. And I mean, I'm not sure. I'm sure everybody on the phone remembers that, or on this go-to. By the way, I'm sorry for being on the phone. I just not able to get in front of a computer right now. So thank you for letting me be on the phone today instead of on video. But after 9/11, I remember the very first day you could fly. The very first day, I actually had a speech that I had to go to, and that day I went to the airport. And in the holding area before you board the plane, I will never forget a bunch of guys kind of huddling up, and they kind of pulled me into it. And where are you sitting, and are you on the aisle? And we were all going to be want to be Todd Beamers to save the day if something happened on this airplane. And it was, as I look back on it, that was an unbelievable time. And then for the, I don't know how much longer everybody felt weird, but last year we had more people fly than ever before. We have TSA now, we have locked cockpit doors, and people don't really think about it anymore. And so we eventually get back to normal. And my belief is that we will get back to normal after these coronavirus shutdowns and these coronavirus fears as well. It's just going to take time to reinvest in those businesses that close, to have people feel safe being in a theater or at a professional sporting event, or any kind of sporting event for that matter, a kids event or a college event or a professional event, a movie theater. It's just going to take time, and all of that means that it will have a V-shaped recovery at the beginning, but then I'm kind of calling it a swoosh after that, where we slowly but surely get back to where we were back in the early part of this year. We had 3.5% unemployment in February, and today it's 13.7. My expectation is that we finish the year around 8, and over the next couple of years we do get back below 4, but it's going to take a couple of years. Sorry for that long answer, Brian, but there's a lot to think about there.
Yeah, no, that's great. Thank you. So some of those trends that you mentioned had been occurring already, but they were accelerated with the pandemic. For example, people traveling less often because of more calls like we're on now with video conferencing, eating out less often, streaming their entertainment at home, not going outside the home for their entertainment. So do you feel like that is a major concern going forward, or is that just going to shift where people are spending their money?
Yeah, this is I mean these are deep questions, Brian, and I just want to kind of hit the sort of the highlights, because I think I always thought two brains are better than one, five are better than two, and so we all need to kind of think about this. But here's a few of my thoughts, and I want to throw in a little bit about investing just before I give some broader macro comments. A lot of people have said, "Hey, how is the stock market recovered so quickly while the economy is doing so poorly?" And there's a few things that I want to point out. First of all, if you've made it into the S&P 500, or basically if you've been, done an IPO and been publicly listed, for the most part, that means that you have a pretty solid business, and you have a good group of customers that you're taking care of. Doesn't mean every company is perfect or has a perfect balance sheet. We all know that's not true. But if you've made it to that level, you're a pretty solid and successful company. So if you compare that to a small restaurant, a lot of these restaurants, they literally are almost going from week to week. It's almost like someone living from paycheck to paycheck. And I know that food wholesalers really worry about the financial condition a lot of the restaurants that they deliver food to, because they can. If they close down for 2 weeks, they're basically in deep doo. And so the S&P 500 companies have an automatic benefit of having some cash on the books, having a pretty solid balance sheet, having a really well-tested management. But then on top of that, many of them, big market cap companies, are tech companies that helped us get through this. They're also companies that were allowed to stay open. So you think about Home Depot, Target, Walmart, Costco, and a lot of their competitors, the small mom and pop retailers and food stores, had to shut down. So what's fascinating is that those tech companies won because they provide the tools like we're using today to talk to each other. They also won because in many cases they were allowed to stay open when others couldn't. And that's also true for healthcare companies as well. And this is one of the key reasons that the market has done as well as it has. And I think if anybody really wanted to dig into the companies that did the best, they're going to be those tech companies that have allowed us to survive. So as we move into the future, is this, we're going to need less office space, or people not going to go back to theaters? Will sporting events now be played with no crowds in the stands? And my view is that in the longer run, I don't think that's really viable. Human beings want to be in contact with each other. We are not solitary creatures, and sitting in your living room with your computer for months and years on end, I think is a recipe for ill health, and not good things. And so in the end, I think people will also, you think about an office, it's a collaborative environment, and I know we can do Zoom meetings, but this doesn't account for, accidentally running into somebody at the water cooler or in the hallway or in the bathroom and having a discussion that you might have not had otherwise. And so I think in the end, we're going to see things go back to the way we remember them, although at the same time, there is an acceleration of other things, right? So Amazon probably pulled 2 years of growth out of the last 2 months. And people are now used to having Prime accounts and having stuff delivered. I know they already did, but that their share of the retail business has gone up. Online share of retail activity has exploded in the last 3 or 4 months, and I'm not sure that'll ever go back to normal. But I just can't. I do not believe we will not have sporting events. We will not have larger gatherings, and that we won't be using office space. Maybe a little less. And by the way, I think we're going to open restaurants fully again at some point. Viruses burn out. I'm not trying to be an epidemiologist, but the Hong Kong flu, the Spanish flu, every single one of them, of these deadly viruses, burned out eventually, and this one will too. I'm not trying to predict when or whether there's going to be a second wave or not. I could give you my opinion, but it will burn out, or we will get a vaccine, and at that point, I think we go back to normal. I think we go to back to a much more normal picture than we have today.
Yeah.
So thanks, Brian.
Yeah, thank you. I think we would agree with those sentiments. And now the one thing that we continually hear about from people who are a bit less bullish is inflation. And so trillions of dollars in stimulus has been necessary to allow consumers and businesses to remain solvent until the lockdown ends. And recently there's even talk of additional stimulus, such as investments in infrastructure and even another round of checks. And so a lot of people have been arguing that all of this excess liquidity circulating in the economy could cause inflation to rise dramatically if the demand for goods and services bounces back too quickly. But then again, central banks have been unsuccessfully trying to generate inflation for years because of many global forces. Just to name a few, the corporate global supply chains have been extremely flexible and can be adjusted to increase their efficiency. Global competition has been rising for decades, keeping price levels down. Companies are increasingly using technology to become more efficient. And there's been a surplus of workers in many industries, keeping wages low. And so I guess the argument is that some of these forces that have held inflation in check may be waning. And that also might be accelerated because of the pandemic as people retreat from the global economy. So I'd be curious to hear your thoughts on whether the stimulus spending is going to finally cause inflation to spike higher.
Yeah, Brian, there's really, I kind of think there's really 3 things going on. I want to divide it into 2. The first is, if everyone on the call took Econ 101 or came pretty close to it at some point in their life, and we all learned about supply and demand, and that's what determines prices. And if demand exceeds supply, then you end up with a problem. Well, one of the things that's interesting is that we put a lot of people out of work because governments shut down, and I'm going to make a little aside here. There are a lot of people that are worried about the government's spending, and don't hear me wrong. I do not believe adding $3 trillion to the government's debt in a matter of months, and then potentially adding another trillion or even more in the next month is a good idea. I don't think it's a good idea. However, there is a reason, in a sense, that we did it, and it's a constitutional reason if we think about it. And this is the way I've kind of come to grips with it, and that is when you force businesses to shut down in the Constitution, I believe it's the 15th Amendment, it's called a taking. You've taken someone's private property, and then we have to give just compensation. And so in a way, this is it's kind of driven by the fact that we took people's ability to keep their business open. We had to provide some kind of just compensation for it. But think about what that did. So we shut all these businesses down, which reduces the supply of new goods and services. At the same time, we borrow money from future generations, and we give that to people today to spend. And so we have an increase in demand and a decrease in supply. Now, at the same time, we also saw a decrease in demand because at the worst, gasoline consumption was down about 80% from a year ago. People stopped driving, and if people aren't flying, so there's these demand and supply side pressures. On one hand, less people are flying, but airlines put planes in deserts, and you can only sit every other seat now, and et cetera, et cetera. So, or in a restaurant, you can only have 25 or 50% of your seats. So there's less supply and less demand. And the real question is how to balance that out. Now, I would argue that when you throw trillions of dollars of money into the economy and put it into people's hands who aren't producing something, they're just receiving unemployment benefits, and it was a taking. I'm not belittling them that, but that is an inflationary impulse. There is no doubt about it. And then the second thing that I would bring up, other than supply and demand, is that in the end, inflation really is about the value of money. It's not always about supply and demand. It's about the value of money. And if you print more money than you create new goods, then what happens is you end up with inflation. And you're absolutely right. The Federal Reserve for a decade, through quantitative easing, tried to push money into the economy, tried to boost the inflation rate, and couldn't. And so then the question is, why did that happen? If you print trillions of dollars, which is what the Fed did between 2008 and 2015, how come you don't end up with more inflation? And my belief is that the reason is that money that the Fed was printing did not actually enter the economy. It did go into the banking system, but the banks actually held that money as excess reserves. In other words, it's money that the banking system did not lend out. And so while the monetary base was growing 25% a year, M2, that's what Milton Friedman always watched, the M2 measure of money, which for anybody that cares, is all deposits in all banks, right? It's the cash that's in the world. M2 only grew 6% from 2005 or 2008 all the way up to 2019. This time, the Fed has pushed trillions of dollars of quantitative easing into the economy. And then at the same time, we had these new government-sponsored loans, the PPP program. And so this time, the quantitative easing, the monetary base that the Fed printed, it actually did turn into money. And in the past 3 months, the money supply, the M2 measure of money, has grown 86% at an annual rate. M2 is now 26% above where it was a year ago. I've been an economist for 35 years. The Fed was started in 1913. I've read just about every history book and kind of biography of governors and the Federal Reserve itself that's ever been written. I don't know of money supply growth numbers like we have seen in the past couple of months. And that is what worries me about future inflation, because you can't print all this new money and then hold back the supply of new goods and have every dollar worth what it was. That's one of the reasons why gold is up. I also believe that money is flowing into the economy. It's helping the stock market. It hasn't pushed us to overvalued territory, but it's it will be an impetus behind economic growth and I think a little more inflation in the years ahead. I have never seen money supply growth like this. It's I don't want this to sound over the top, but it's kind of scary to me because if you look back in history, we're printing more money than we even did in the 70s. And in the 70s, we got up to 10, 12, 13% inflation. I do not predict that right now. I think the next couple of years, because of supply and demand forces, inflation will remain relatively mild. But there is a chance that we get a drop in the value of the dollar and a pickup in inflation that is bigger than a lot of economists expect. So I hope that was understandable, Brian. It's some of that stuff is pretty complicated economics.
Yeah, that was very helpful. Thank you very much. So let's shift to the stock markets a little bit. We talked a lot about the economy, but stock prices have now recovered to the point where even after today, where depending on where the S&P finishes, the S&P is going to be down somewhere around 4 or 5% since the end of last year, and it has rebounded extremely strongly off the bottoms that we saw earlier in the year. And some people have said that that move higher has been too fast. And the rise in stocks from the bottom of the sell-off has taken place despite the worst unemployment since the Great Recession, the biggest drop in manufacturing since the global financial crisis, plunging leading economic indicators, and a severe drop in corporate earnings. And as we mentioned earlier, recently the economic data has improved, but almost all economic indicators remain well below where they were prior to the pandemic. And so investors are projecting a strong economic recovery the second half of the year. But as we mentioned earlier, a return to prior economic activity could take a long time. And so some have worried that the divide between the stock market's bounce off the lows and the current level of the economic data may be setting the stock market up for another sell-off. So, Brian, what do you believe? Why do you believe that the stock market has rebounded so strongly, and do you think it's gone too far too fast?
Yeah, this is there's so many things going on with equities. One of the if you just look at the S&P 500, and I think everyone on the call understands this, it is a market cap weighted index. So, Brian, you correct me if I use the wrong number here, but I think you probably know it. But the FANG stocks, if we look at Facebook, Amazon, Apple, Netflix, Google, these are huge companies. Netflix is pretty small compared to the others, but these are trillion-dollar market cap companies, and I think they make up something like 14% of the S&P 500. It might even be a higher number than that. Do you know that number? I'm pretty close, I think.
Yeah, I do think it's a little bit higher than that. I think it's in the 18% range, I believe.
Okay. Yeah. Okay. So 18% today. That's the number I didn't know. I think if you go back to last year, it was about 12, 13%. So right there, you see an explosion in the value of these massively large companies, and that has a big influence on the index. If we go look at airlines and hotels and energy companies, a lot of them and cyclical companies, automobile companies, they are still way behind where they were, while a lot of the FANG stocks and similar companies, tech companies that allow us to communicate are at all-time highs. And I think that's one of so the stock market has exploded higher partly because of these huge companies doing so well. Now the question is, will the other companies catch up? I personally just as a quick aside, really like energy companies, partly because I think oil was undervalued, and the money supply growth that we've seen is going to help boost commodity prices in the months and quarters ahead. So I think in fact we actually saw that a lot of people shut down wells, and we have now started opening up wells and even drilling and fracking again, because oil prices are now back up over $40 and these wells are profitable again. So I think we're going to see some rebound in these cyclical companies, but we shouldn't be overly confused, because I mean, when you look at the FANG stocks, and I want to use FANG in a really big sense, because there's a lot of technology companies that are behind them. They're not just the huge ones, but that have done extremely well in and of themselves too. They're just not as big. They don't move the S&P 500 as much. And so I think they're kind of, in a way, permanent winners, because we all knew that more shopping was going to go online. Little did we know that it was going to ramp up this fast. We all knew that technology was valuable and we could have Zoom meetings. Little did we know that we were going to have this many Zoom meetings or Skype meetings, or there are many other companies out there that do that. So I think that's helped push a lot of things along. The second thing I want to talk about really quickly is sort of a fundamental analysis. And, this is where I disagree with the people that say we're in a bubble. At the bottom, that week before Easter, the worst spot for the stock market once we shut down, the market was ignoring the virus for a while, then we started to shut down and we plummeted. We calculate, we have a pretty simple model that we use. I say simple, but it's based on fundamentals, and that's what I think fundamentals are kind of simple in the long run. Profits drive stocks, we know that, but then a dollar's worth of profits is worth more when interest rates are low. So if you go back and look at where the stock market was, the S&P 500 was that week before Easter, what we did is we took interest rates as they existed, and then we calculated backwards. We said, what do profits have to do to justify this level of the stock market? And the number we came up with is that the U.S. stock market was expecting an 80% decline in corporate profits. Right now, I think the worst estimate I've seen is about a 30% decline. We believe it's going to end up being about a 20% decline. So what I would say is that the stock market was oversold, that we were never going to have an 80% drop in profits. It's going to be somewhere around 20%, I think. The worst estimate I've seen, as I said, is around 30. But when you put those numbers into our model, and remember, we have extremely low interest rates, so that helps the valuation of the market. We still believe that the U.S. stock market as a whole is undervalued. And so I know people look at the market and they're confused, but we have to remember that the stock market isn't the economy. It's what we expect out of future profits. And a lot of companies are going to actually do better than they did without the shutdown. I mean, as I said, there are some companies that are open while their competitors are closed. There are some companies that we can't live without, the FANG kind of stocks that make our life bearable today. I mean, imagine if this would have happened 20 years ago. And so my view is that the market's still undervalued. I do not think that there are a lot of massively overvalued companies out there right now. In fact, I'm of the belief that we are not going to shut down again like we did. I don't think people will put up with it. And I think now, as we look back, I'm not making any kind of political statements here, but when you throw 20 million people out of work, you throw in a shutdown where you're telling people to be, they have to lock into place. Then you have racial issues, and it's all set for an explosion of emotion. And I believe that as politicians look at the damage that was done, remember, if you're the governor of a state, your revenues have plummeted, and at the same time, you've got riots on your hands, whether you like them or not. I'm not making a political statement, but everyone knows that the shutdown was part and parcel of each of those things, and that's. It's a virus. I know it scares a lot of people, but we know who to protect. We know that the death rates for people under 65 are flu-like without underlying conditions, and so we know who to protect. We know who. And I do not think we will do a blanket shutdown again. And as a result, I think those companies that kind of got left behind, if you will, because of the shutdown, because of the virus, but are going to begin to catch up with the companies that did really well.
Yeah, I think one bit of data that might support what you're saying is, even though the S&P 500 is just about back to where it was at the beginning of the year, the average stock in the S&P 500 index is down 20%, because the index itself has been driven by those 5 FANG stocks you talked about. But if you take those out of the index, the average stock is down almost 20%.
Exactly, and that's it may be true that we see a 20% decline in their profits. But we also have to remember that when we started this, we had a 1.7% 10-year Treasury, and now we have a 0.7 10-year Treasury. And so unless and the Federal Reserve has said they're not going to raise interest rates until the end of 2023, basically. Now, I'm not holding my breath that that's true, because time changes everything. But with a 0.7% interest rate, that's why I can say that this market is undervalued, even if profits fall 20 or 30%. Again, it's really the change in the discount rate, and the likelihood that discount rate is not going to move higher in the next couple of years.
Okay, yeah, I also think that it's important to note that throughout history, there's rarely been a time when people felt good about investing in risky assets. Just in the United States, we've dealt with these type of issues that you talked about: recessions, depressions, pandemics, even world wars, assassinations. We've dealt with these things before, and through it all, stocks have continued to move higher. And so while there are so many uncertainties, it seems to me that some people only focus on the potential negative scenarios and not the potential positive scenarios. And so could you touch on what some potential positive catalysts could be that could actually propel stocks even higher than what most people would anticipate?
Yeah, this is a really good question, Brian. Let me just focus real quickly on the market today. Okay, so I'm not sure where we are exactly right this moment, but when we started the call, the Dow was down 730 points, the Nasdaq was down about 200. It was a bad day for the market, but we've had a bunch of of days like that. We've got volatility, and today was all about the resurgence of cases of COVID-19 in the United States. And I want to point out, and this is one of the reasons why I don't think we're going to shut down like we did. So first of all, the people diagnosed with coronavirus, with COVID, the average age is getting younger in this latest surge. Now, is that because young people aren't as worried? And they shouldn't be, because if you just look at the statistics, I'm not saying no young person has gotten in trouble, but if you look at the percentages, it is no worse, probably actually better for the young than the flu, certainly than the Hong Kong flu. All right, back in 1968 and 69, which by the way, we had Woodstock during that, and population adjusted, because we had a smaller country then, 200 million people. Today it's 330 million. We had 165,000 people die, and they were of all ages, from babies all the way up to the elderly. In this current environment of our 125, 130,000 deaths so far, 40 to 50% have been in nursing homes, and so I think as people look at these statistics, to come back to the data that we're seeing today, yes, cases are going up. However, hospitalizations and the use of number of people in ICU beds and the number of deaths, even though for the last 2 weeks the number of cases has been trending higher nationwide, all of those hospitalizations, ICU use, and the number of deaths have all been trending down. This is not what happened at the beginning. And so my view is I think that people are that these statistics, which get played, when you have fear, I'm not making a political statement. I don't want to go after the press. I don't want to, but when you have fear, people extrapolate certain data and ignore other data. And so what I try to do is look at the whole entire picture. All right. I'm not out here running around without a mask and breaking rules and doing anything I want. I'm like all of us. We're trying to be careful. We're trying to be safe. But when you look at the statistics, there is no way you can compare what's happening today with what happened back in February and March. And I think as we dig in, the more and more we dig into these statistics, the more we're going to realize that we overreacted with the shutdown. And so that's where I'm focused. If we shut down again, all bets are off. The biggest worry I have, Brian, in all of this is that we've now created a new kind of standard operating procedure for a flu or a virus or a contagious disease, whatever it is, where we shut down the economy, because it's devastating not to the economic growth. I think in the long run, it's devastating to health as well. We're trading off current health, if you will, for future health, because wealth, the resources that we build over time, that's what gives us the ability to fight future problems, whether it be a war, whether it be another virus. And if we have less wealth, if we have less growth, then any future problem becomes even a bigger deal than it would have been otherwise. And so I think as people think through these things, I don't think we're going to make this standard operating procedure, and therefore the reaction that we're seeing in the market today is overdone. And we're going to get back to normal. It'll take time. I'm not saying people will lose their fear overnight, but I do believe that they will lose their fear, and that's what can propel us to new all-time highs in the market.
Yeah, thank you. Just shifting gears for a little bit. Obviously, there's a lot of attention being paid to the presidential election this year. And we have been reminding our clients that even though the news media places a lot of importance on how the president impacts the markets. Studies have shown that the economic cycle tends to move independently of the presidential election cycle. Not that it doesn't matter at all, but the data that we've reviewed and studied seem to indicate that the person in the White House actually has minimal impact on the economy and the stock markets. As a matter of fact, some studies have shown that what really matters is not the executive branch, but what monetary policy is. And currently the Federal Reserve's policies are stimulative. So all of that being said, would you agree with that assessment? And how would you incorporate that into your forecast, if at all?
Yeah, so I'm going to start out this way. So just so everybody knows, when I get a political question like this, where I'm coming from, I would call myself a libertarian. Now, somebody on the call may hate that. I don't know, but you need to know where I'm coming from, and I'm willing to talk reasonably with anybody, about anything. And a libertarian, this is from a policy perspective. As a libertarian, I want lower taxes, less spending, less regulation. I believe entrepreneurship and free market capitalism creates wealth. That's why the United States is the wealthiest country in the world, and that's what I believe in. So I do believe policies matter. Having said that, let's go back to President Obama's 8 years in the White House. I did not support the tax hikes. I did not support the regulation. In other words, I felt like it would have a detrimental effect on growth. However, at the same time, we live in an era of it's unbelievable technology. So if you kind of think about it, the economy, let's call it a racehorse, okay? And the only way you're going to win the Kentucky Derby is to have a 113-pound jockey on there. I'm not even sure. I guess they change it every year, and every horse is a little different. But you can't win the Kentucky Derby with a 200-pound jockey. All right, and so there are a lot of people, and if you go back to President Obama's tenure, one of those, Sean Hannity, for example, every night, if you would have watched him on Fox News, he was telling people there's going to be a depression, sell all your stocks. I mean, in fact, he had me on one time on his radio show, and he asked me how we've raised taxes, Obama's terrible, we've increased regulation. What do you think? And I said, well, I think the stock market is undervalued. I think the economy is not going to fall into a depression or a recession, and I think people ought to invest in stocks. And that was the last time I was ever on his show. All right, and so because here's the way I thought about it, and that is, okay, we have a racehorse. It has a heavier jockey because we've raised taxes and we've increased regulation. However, the horse, because of all the FANG stocks, for example, the new technology that we have out there, that it's more productive, it's stronger than it's ever been, and we may not win the Kentucky Derby. In other words, we're not going to grow 4% real GDP a year. We might only grow 2% real GDP a year, but we're still going to grow. We're not going to fall into a recession. So if you can kind of think of a scale, if you will, you put more weight on one side, more on the other. Those are the two forces that I think balance out. It's, okay, what's the government doing? And then what's the private sector doing? What's productivity? What's new technology versus the tax hikes or tax cuts? And I think it's the combination of those things that you have to figure out to determine whether the economy will grow or not. We are living in an exceptional era. We live in an era of sustained productivity increases because of technology. It's called the networked economy. And actually, Brian, if I know we're running close on time here, but let me just give this quick example. I'm going to use the fax machine as my starting point, and that is if you bought the very first fax machine that was ever produced, it would have cost you $25,000, maybe 50. I don't even know. It's a lot of money. But then the question is, how much was it worth? And the answer is nothing, because nobody else had a fax machine. So you couldn't fax to them, and they couldn't fax to you. But then the second fax machine, now all of a sudden those two fax machines are worth something. The 10th, the 100th, the millionth, the 100 millionth, every new fax machine that's added to the network makes the network more valuable. And that's just like our phones, our iPads, our computers, every new app, every new user, every new program, every new company that puts a website up and makes it easier to use makes that network more valuable. And we've just cracked the human genome. And so I think you're right, Brian. And that is, yeah, we could make I do think government could make mistakes that are big enough to hurt the economy badly. But usually it comes from the Fed, and it's a combination of Fed mistakes and congressional or even presidential mistakes. But in the end, what really drives we don't invest in GDP. We invest in companies. And right now there are companies, technology is boosting profitability and productivity in ways that a lot of people just can't see if all they do is look at industrial production data or gross domestic product data. Because where the real action is happening is inside of these companies and their customers becoming more productive. And so I think you're absolutely right that policies, they can matter, but most often the changes are incremental enough that we don't see any. You have to go back to the Great Depression or the 1970s, 60s and 70s to see a change in policy that had a massive impact on the economy. And right now I don't see that happening.
So are you okay just to hang on just for one last question?
Sure, absolutely.
Okay, because I do want to touch on foreign stocks just real briefly as the last question. At HBKS, one of the ways that we manage risk is by having a globally diversified portfolio. And so while we would agree that stocks in the US will continue to outperform foreign stocks as a whole, we do believe that there are pockets of value, and a properly diversified portfolio does need to have some amount of an allocation to foreign stocks. And then especially now, with many of those pockets of foreign stocks having a lower valuation than US equities, stronger growth and higher dividend as a whole. Also, economic activity in many places around the world may bounce back more quickly from the pandemic because it happened sooner. Just the other day, we saw some of the manufacturing and services activity rebounding strongly in many developed economies. So if you could just talk real quickly on your thoughts on maintaining an allocation to foreign stocks.
Yeah, I think it's really important, and I'm going to lean on. I'm not a strategist. I do talk about valuation, but at First Trust, we have Dave McGarrell, our chief investment officer, Bob Carey, our chief strategist, and both of them, when they look at real valuation models, are agreeing totally with you that that many foreign companies. You think about SAP. I've never known what that stands for, but it's a German software company. They're basically Oracle, and they compete for the same customers. Or you look at some of the German or European industrial companies, and they basically compete against GE or Emerson. And when you look at the valuation of those stocks, I mean, SAP and Oracle have the same customers, and yet SAP is cheaper relative to its earnings than Oracle is. And so, yeah, I think you need some exposure. Also, we're going to see some big changes coming in the world. The U.S. did, I mean, I know this isn't a highly technical term, but tons of business with China, and that a lot of that business, because of I mean, there are a lot of people that are mad at China, is going to move to other countries. We see Taiwan winning, Japan winning. We have a new trade deal with Japan. I think we're going to get a new trade deal with the UK. So I would totally agree that there are forces out there at work that would suggest that being diversified into some of these international areas is key. I am worried about Japan. I think the world is mad at them, and I think they're losing supply chains, not just because of the tariffs of the U.S., but because of what people feel was, I mean, I don't know, I guess you could call it, a lot of people say they just lied about the virus. And I think this is going to hurt them economically, and there will be winners as China loses. So being diversified, I think, is key. And by the way, that doesn't mean there aren't Chinese companies that are going to do pretty well in the future, because they have good tech firms as well. But the bottom line is being diversified internationally it's always a good idea, in my opinion. The one place, if I were to worry about one thing, I believe that the U.S. Treasury bond market is overvalued. I am worried about owning Treasury bonds. Now, there are corporate bonds, there are municipal bonds, there's other forms of debt out there where you can get a spread on these treasuries. But even though yields might stay low for the next couple of years, I am worried that with the debt levels out there, the money supply growth, the potential for inflation, that these U.S. Treasury yields that we are seeing today are going to be the lowest we see in a long, long time.
Okay. Well, thank you very much, Brian. I think our time is up. We're a little bit over, but thank you very much for joining us today and providing your perspective on the markets and what to expect in the coming months.
Yeah, well, thank you, Brian. Thank you for all those questions, and I'm sure you want to say a couple of words to close up, but I really appreciate it. It was great to be on and have this discussion with you.
Thanks, Brian. We appreciate it. Yeah. So before I go, just like to remind everyone that HBKS believes strongly that no matter what happens, investors should never try to time exit and entry into the markets. We believe in having a long-term strategic allocation and sticking with it. And I would encourage you to talk to your financial advisor if you have any concerns or are nervous about the structure of your current plan, or if you want to rethink your plan. And also you can go to hbkswealth.com to see some of our latest thoughts on these and other issues. And with that, I'd like to thank you for attending the webinar.